Welcome back. You're watching The Money Show. It's time for our Spend with TMS segment. And the one question that's really been on everyone's mind is that home prices have fallen so much. It looks like a buyer's market. So is this a good time to buy a house? In fact, it's not just recently, but I'm sure for many people who've been on the hunt for a home, who perhaps have been living on tenanted homes, have really had this question on their mind for some time. So we'll help you figure out if the next summer finally usher in the Shubh Muhurat to buy your home. Let's introduce on the show Mr. Ramesh Nair, the CEO and country head for India with JLL. Mr. Nair, thank you so much for joining in. So to start with, I'm going to first take on both the investor aspects. If I have used my money, to sort of surplus money, of course, to park it in realty, looking at it from an investment perspective, I may not have been very happy because firstly, appreciation has not been that good, and secondly, even yields are very poor. So why do you think this has been so? I mean, is this a good investor market for realty?
When you look at the real estate market, you shouldn't look at it from a 2-year, 3-year time frame. I think it's very important that one looks at it from a 5 to 10-year point of view. And if you look at the last 10 years, over the last, if you look at the top 7 cities, there's actually been capital appreciation of nearly 41%. And if you look at cities like Pune, where it's gone up by 91%, Hyderabad, it's gone up 54%. Bangalore, it's gone up nearly 40%. So that's very important. I agree that the last few years prices haven't gone up much. Various reasons. There's been excess supply. There's been lack of capital appreciation, because of which investors and speculators have stayed out of the market. There's been a trust deficit of the market. Plus, there have been various other uncontrollable regulatory aspects like RERA, GST, demonetization. All this has definitely had an impact on the market, which has also seen some amount of price correction. Over the last few months, obviously there is also the worry of job loss and salary cuts, and also an expectation that prices are going to correct more, because of which there's been a delay in buyers' decision making. But today, look at what the buyers are looking at. They're looking for stability of income, their own income. They're looking at age of construction, home loan rates, and reputation of the builders. And there's also been a change in consumer behavior. Today's buyers are looking a lot more at health and safety, wellness of the buildings. They're looking only at projects which are nearing completion or already completed. They're looking at slightly bigger apartments. They're also looking at moving from dense markets to more suburban markets. And there's also been customers looking at bigger study rooms, open areas, and better connectivity. So all this has had its own challenges in the residential market.
How do you view the market then for investors? Because let's say if somebody has that spare cash and they're thinking that, look, prices are so low, I might as well invest. I mean, would you advise that? Because, even if you look at rental yields, they're very poor, especially in metros.
So let's look at the overall economy. Indian economy is last year, $2.6 trillion economy. Savings is household savings is around 19%, which means around $480 billion. In this, nearly 58%, which is 280 billion, goes into real estate. So we're talking of the biggest asset class in the country, $280 billion annually. I believe investments into real estate is safe compared to many financial instruments, including mutual funds. Firstly, the tangible nature of the assets. Secondly, there's a lot of psychological comfort on security and satisfaction, which someone gets when they invest in real estate. Today, everyone post-COVID is looking at settling down. Real estate can give you that. Real estate also gives you consistent returns. It's a lot more predictable. You don't see Black Mondays and Black Fridays in real estate where your prices drop 15% in one day. Even if prices have to drop 5 or 10%, it happens over a period of maybe 1 or 2 years. The real estate market's a lot less volatile compared to the financial markets. There are tax benefits one gets. There is easy leverage available today. So you have the benefits of passive income plus potential for appreciation. But one needs to keep in mind that real estate is a long-term investment. You get a lot more control over your portfolio, and it helps in diversification from other asset classes, and market risks are a lot lesser in real estate when compared to the other financial instruments.
All right. Well, yeah, definitely more predictable compared to other financial instruments. Even if, let's say, prices crash, they don't crash in just a matter of 1 or 2 days or weeks. It takes a little while. So there is that bit of predictability. Now, despite everything, despite the fear, we are seeing quite a rise in real estate sales. What do you think is leading to this? And do you think that all the offers, freebies, discounts, schemes given by realty developers this Diwali are worth lapping up?
So the last 2 months, we've seen sales go back to a 55-60% of pre-COVID numbers. Multiple reasons for this. There is better sentiments in the market, lower interest rates. Interest rates are currently at a 15-year low. Lower prices. Developers are giving anywhere between 5 to 15% discounts. There is a lot more ready-to-move-in projects today than what is available before. Some states like Maharashtra have significantly cut down stamp duty, and developers today are giving a lot more discounts than giving freebies. Previously, developers would give freebies, cards, gold coins, all that kind of stuff. Today, that's becoming more of discounts, which is kind of attracting the buyers. It's very important that one compares the post-COVID era from the post-global financial crisis era. Back then, valuations were very, very overheated. Today, the valuations are a lot more realistic. Back then, the markets were dominated by speculators. Today, the market is a lot more dominated by end users. It was a seller's market back then. Today, it's a buyer's market. A lot more tax benefits now. Also, the interest rates, which I spoke about, we're looking at a 15-year low in terms of interest rates. Back then, all developers were building luxury, big apartments. Today, developers are building a lot more relevant, compact apartments. And also, what is selling today? The apartments which sell are apartments which are in the right location, high quality, financially feasible, reputed, built by reputed developers. Preference obviously is for projects where there is an assurance for delivery. What we also believe is during festival times, we've seen it every year, there is a lot more fast tracking in decision making. And one needs to keep in mind that the number of new launches are also kind of reducing, and then supply reduces automatically over a period of time, prices will start going up. And the gap between rental yields and borrowing costs have also kind of come down as interest rates kind of come down. And we're also seeing more interest coming from NRIs and joint families looking for apartments. So all these reasons are leading to whatever we're seeing in the last 2 months. Also the pent-up demand of not much of sales happening in the second quarter of the calendar year, which is leading to much more increased demand in the last 2 months.
So finally, what's the verdict then for somebody who's been looking to, buy a home for themselves? Is this the best time?
So this is surely a good time to buy a home if you're looking to buy a home as an end user. I would strongly recommend end users to buy homes over the next 2 to 3 quarters. One, prices are realistic. Two, prices are reduced. Like I mentioned, home loan rates, 15-year low. There is definite affordable synergy in the market. Developers today are also offering attractive payment plans and schemes. There are some payment plans which could, when you convert it into pricing of a home, could easily be 5 to 7% of the actual price. Time value of correction has already happened over the last 4 or 5 years. prices haven't gone up, which also means that given inflation, time value correction is already happened. Developers are offering discounts, like I mentioned, 5 to 15%. One needs to keep in mind that rack rates, when you go to a developer, he's still keeping the same. Discounts are typically offered for buyers who are serious, and that also at the last stage. So it's important for you to show the developer that you're a serious buyer and you're at the last stage of taking a decision. Room for further big, massive price drops looks limited at this point of view. One needs to keep in mind that developers are already operating at very low margins, and chances of further price reduction going down looks is not likely, particular in the affordable and mid market, where prices are margins are already low. I feel overall the price curve may move up upwards once the virus is contained and the economic recovery sets in.
All right, so it is definitely a good time, to buy a home for yourself, especially if you've been looking at it for your use, you and your family's living. Mr. Nair, thank you so much for joining us today on the show and, giving us your take on the real estate market and what can investors and end users alike expect in the next Samvat. We'll take a very short break, but when we return, our Spend with TMS segment continues. Don't go anywhere.